Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day.
This is GE Vernova, helping generate and move the energy that will change the world. Welcome to a new era of energy.
If not in seconds, the $16 billion wealth of former FTX co-founder Sam Bankman-Fried was gone in hours. FTX, the world's second biggest crypto exchange, has gone bankrupt. Over 1 million crypto investors cannot withdraw their money now. This bust has triggered another round of sell-offs on other exchanges. Bitcoin plummeted another 12% in the last 5 days after shedding over 70% this past year. So is it the beginning of the end of crypto?
Even as its chief executive Sam Bankman-Fried resigned, embattled cryptocurrency exchange FTX is set to initiate bankruptcy proceedings in the United States. The announcement has triggered what many experts have said could be one of the biggest meltdowns in the industry. With FTX's dramatic collapse and the crypto markets facing strong global headwinds over financial year 22 and 23, do we hear a death knell for cryptocurrencies? The collapse of FTX, considered by many as a white knight of the crypto market, marks a stunning reversal of fortune for the company and its founder Sam Bankman-Fried. It also raises questions about the future of smaller firms like BlockFi and Voyager Digital, which had signed rescue packages with FTX earlier this year. But why is cryptocurrency market facing stumbling blocks? Business Standard's Devanshu Datta explains.
Cryptos as an asset class started collapsing about 6 to 10 months ago. The combination of high inflation, strong dollar, Ukraine war, etc., all generally spooked investors. And since essentially your valuation of something like crypto is entirely driven by perception, since it's not anchored to any fundamental asset as such.
FTX's collapse has dealt a fresh blow to the cryptocurrency industry, which has seen severe volatility and bankruptcies of other high-profile firms, including Celsius Network Limited. This has caused the White House, which said it was closely monitoring the collapse of digital asset empire, to call for stringent regulation of the cryptocurrency industry. A proof of reserves has emerged as a popular option for regulatory tools. Can proof of reserves prevent future crypto exchange collapses?
We would really have to wait and see what's the real implications, because what exactly a proof of reserve does, it gives a third-party audit to actually audit the systems of the crypto exchanges. So a third party is primarily doing an audit to find things are in place, things are transparent and efficient, primarily to gain the confidence of the investors. So such kind of a concept would actually bring the confidence of the investors.
Datta agrees that the utility of proof of reserves will be subject to other factors.
So of course, proof of reserves could make a difference, but it could only make a difference to a certain extent. If the transaction volume is higher, transaction and default volume is higher than your reserves, then the exchange will default anyway.
Saha also argues that central bank digital currencies or CBDCs are not a viable alternative.
CBDCs can be an alternative to crypto exchanges. I would really say it might not be, because cryptocurrencies are digital assets, and CBDCs are essentially, a digital fiat currency, right? Primarily owned by the central banks. Of course, the confidence level and the reliability is more because it's being owned and functions and operated by a central bank authority. But it's certainly not an alternative to a cryptocurrency because these are not digital assets.
Datta even highlights that CBDCs are ideologically opposed to the idea of cryptocurrencies.
First things first, cryptocurrencies were thought up specifically because the first lot of people, Satoshi Nakamoto, whoever he or she was, and the pioneers who came after that, actually wanted to avoid getting controlled, as they thought, by fiat currencies. So there's a clash of ideology.
Regulation seems to be practical way forward in stabilizing the crypto market. However, implementing regulatory tools like proof of reserves can be challenging. It needs to be introduced considering several other factors ruling the crypto market. With a looming fear of global recession, if a well-strategized solution is not adopted soon, this might well be the beginning of the end for cryptocurrencies.
Finance Minister Nirmala Sitharaman and US Treasury Secretary Janet Yellen discussed cryptocurrency regulations when they met last week in Delhi. Meanwhile, the waiting period for US visas are expected to ease by mid-2023, a senior US embassy official recently said. That's cold comfort for many Indians who are facing a waiting period of up to 900 days for appointments. So what has been the impact of the particularly long queue for US visas? Let's find out.
Everyone wants a piece of the American dream. Whether as a tourist in the Big Apple, a student at one of the world-renowned universities in the US, or as a business traveler playing a part in deepening US-India commercial ties. But long waiting periods to secure a US visa have derailed such dreams for many Indians. With their travel plans in limbo, students, particularly, have faced uncertainty about their college admissions. On 14th November, an Indian applying for a B1 or B2 visitor US visa from New Delhi had to wait for about 925 days for an interview appointment. In Pakistan's Islamabad, that period was only 373 days, and in China's Beijing, 2 days. For a student or exchange visitor visa interview, the waiting period in New Delhi was 43 days, 4 days in Islamabad, and 2 days in Beijing. For a petition-based temporary worker visa interview, it was 317 days in New Delhi and much fewer in Islamabad and Beijing. The situation appears to have eased for students at least. On 31st October, news reports said that there was an average waiting period of 400 days for appointments for student visas across US consulates in India. That makes economic sense for the US. In June, a senior US embassy official had said foreign students were a big business for the US, with Indian students contributing over $8 billion a year to the American economy. Anand Srinivasan, Chief Commercial Officer of travel company 2Hub, says US visa delays have become a real cause for concern for the Indian travel industry. The current waiting periods for business and travel visas are unprecedented. Citing the US Travel Association, Srinivasan says the delays in visa processing will prevent at least 7 million people from visiting the US, of whom Indians will be a significant chunk. Srinivasan admits that the US government is facing many challenges in visa processing, particularly due to the impact of COVID. According to him, visa processing used to be a well-oiled machine before COVID, but the pandemic saw many staffers move out and led to cost cuts. The industry is cautiously optimistic about statements from US officials that delays will ease up in the coming year.
But now, what we are hearing from governmental sources is that starting mid next year, probably these challenges would be sorted out. But our concern is that whatever opportunities that have been already lost during this period is going to remain lost for the industry.
Things have eased on some fronts. Srinivasan says that renewals are easier now, and student applications are also not seeing as much delay as B1 and B2 visas.
But for new visa applications for tourists, I think we'll have to forego US as a destination for at least quite some time.
Towards the end of October, while visa delays for the UK were far less than the US, the 2-month period was still double the standard time. The embassies of Switzerland and Germany had also advised applicants on their websites about possible delays. An Indian External Affairs Ministry official had told Business Standard that the COVID impact on staffing in consulates was over, but the backlog for Indian visas had climbed only from early 2022. These delays were linked to India's political position on the Russia-Ukraine war, which was against the European stand. Last week, American embassy officials in New Delhi said the average wait time for a US visa appointment was likely to improve to pre-COVID levels only by June 2023. One official said by next summer, they expected to take in as many applications as they were accepting pre-COVID. This would reduce the overall pending appointments, but wouldn't necessarily reduce the processing time. New rules were also introduced for several visa categories to allow more people to opt out of interviews, getting slots for which have become difficult. The embassy is heavily banking on its latest intervention, the drop box, to bring down pendency. At present, it is prioritizing petition-based employment visas for temporary workers. This includes key visas such as H-1B. The Department of State has also relaxed the interview requirement for student applicants who have earlier been to the US on a short stay visa. Visa delays are an emotive issue. Indians have had a harrowing experience, from missed weddings to late college admissions. It could end up upsetting India-US ties in the short term. As such, it would be in the best interests of both nations to find a solution, and find one soon.
Moving on to the markets, shares of companies within the ambit of the digital theme have succumbed to the turmoil in the global tech industry as recession fears continue to rise. So, what do experts recommend against this backdrop? We find out in our next report.
Investors seem to be shying away from stocks of companies in the digital space, with most counters comprising the Nifty India Digital Index giving negative returns in the past year. The index, which tracks a portfolio of stocks within the e-commerce, IT-enabled services and telecom services space among others, has lost nearly 19% in the last 1 year as compared to 1.3% rise in the Nifty 50. The prominent index losers include PB Fintech, FSN E-commerce Ventures, IndiaMart, Zomato, Oracle Financial Services, HCL Tech, Infosys, TCS, Tanla Solutions, and IRCTC. Analysts, however, say that the entire sector need not be clubbed together under one umbrella. They say that a one-on-one investment could be the right way to go ahead in this space.
The last 2 years, there were a lot of tech companies which have been listed. Where many companies were not making profit also. But the valuation was very high, and those companies have corrected more than 50-60%. Case of Nykaa, PB Infratech, Paytm, Zomato, all tech companies or digital companies, everything has corrected. Even pharma, if you take Supriya Pharma, has corrected 50%. So, the latest companies which came in digital have been in last 2 years. and most of the stocks have corrected. Even the companies like Naukri has corrected, Hassel India has corrected. So, and Nasdaq also has corrected. So anything which is related to tech has corrected, and it has corrected big. See, there are many value pockets there, but everything is not value. So you have to take it case by case. If you take Naukri, or if you take IT companies or telecom companies, telecom top 2 companies, we like it. IT companies, I think, in next 6 months, it might bottom up. So people looking for 2-3 years, they can start to accumulate. But more to do with the new tech companies like Cartrade, PB Infotech, Zomato. I think we need to give another 1 year and see their performance and then only buy.
Analysts at Nomura also remain cautious on the Indian IT sector as they expect a demand slowdown in the months ahead if a recession sets in globally. Investors are likely to be disappointed on revenue growth in FY24. We prefer large caps over mid caps in the current environment. Our buys are Infosys and Tech Mahindra in large caps and Persistent among mid caps. Our reduce ideas include TCS and L&T Infotech. On the other hand, G. Chokkalingam, founder and chief investment officer at Economics Research, believes that stocks of IT players such as Infosys, TCS and Wipro can eventually make a comeback once the US markets stabilize and the industry moves past attrition woes. Chokkalingam advises investors to book profits in the stocks of new age firms as and when the valuation improves. According to the analyst, some of the digital or new age companies debuted at steep valuations compared to traditional technology firms. The rally fizzled as they failed to make decent profits. These companies will take over 2 to 3 years to make profits, which could make their valuations attractive. Retail investors should exit these whenever there is revival in stock prices. That said, market action will be guided by global peers today. Sentiment will also be guided by macroeconomic data, CPI and WPI, which were released on Monday.
The government, meanwhile, approved the framework for sovereign green bonds last week. It is likely to hit the market soon. India is steadily moving towards meeting the ambitious green target. So is most of the world. But a few companies and even nations are posing a threat to the world's march towards a green future. They are not cutting emissions, but corners. This practice is called greenwashing. Let us know more about it.
At the ongoing climate summit in Egypt, Secretary General of the United Nations Antonio Guterres on Tuesday said that the world must have zero tolerance for net zero greenwashing. He said that the current loopholes can be used by private companies and sovereigns to drive a diesel truck through. This was the first time that the term greenwashing found a mention at the UN platform. But what exactly is greenwashing? Greenwashing is the practice of misleading consumers and agencies into believing that the companies are taking steps to reduce their emissions towards the net zero targets. But in reality, they are not. The step may look eco-friendly, but it is often done to save costs or increase sales. The term was coined in 1986 by environmentalist J. Westerfeld. In 1983, during his stay in a hotel in Fiji, he found out that the hotel was asking the customers to reuse the towels. While it looked like a practice to reduce waste and ecological damage, it was actually done to reduce laundry bills. Westerfeld later told The Guardian that the hotel was building more bungalows at the same time. Several cases have emerged where large corporations were found to be greenwashing. In 2015, Volkswagen was found to have cheated in emissions testing of its green vehicles. In another case, McDonald's has been accused of greenwashing by replacing plastic straws with paper straws, which were later found to be non-recyclable. In April, the US Federal Trade Commission imposed a penalty of $5.5 million on Kohl and Walmart for misleading their customers into believing that their furniture products were made up of bamboo, while in reality, they were made up of rayon. To prevent greenwashing, a committee set up by the UN recommended that the companies that are pursuing net zero targets must be disallowed to make fresh investments in fossil fuels. They must be asked to show their short-term emission reduction goals. On the other hand, more regulations and standards must be created as soon as possible. It further mentioned that the rule of voluntary disclosure must be changed to mandatory norms.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Offsetting is the most popular form of greenwashing, senior economist David Barnes recently told the BBC. That's all for today. Catch the next episode of The Morning Show tomorrow. Bye-bye for now.
If you liked this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.